Welcome to the debate. Today, we are diving deep into the Q3 fiscal 2025 financial disclosures of Adobe Inc. We're looking at the numbers for the 9 months ending August 29th, 2025. And this period, well, it's particularly rich material. It really captures a crucial moment for a major tech company like Adobe. You see sustained growth in the core business, sure, but also some, let's say, aggressive financial engineering, significant debt activity, massive stock repurchases. And this is all happening while they're funding a really colossal pivot towards generative AI. So the central question that kind of emerges from this reporting is this. Does Adobe's capital allocation strategy, specifically, the use of debt and these huge buybacks, does it signal confidence? Is it designed to maximize long-term shareholder value from a position of strength? Or is it maybe primarily a necessary defensive strategy, something intended to mask, perhaps, the mounting operational cost and the significant investment needed for this rapid tech transition? I'll be arguing that these financial maneuvers are fundamentally a strategic deployment of capital. They're rooted in a position of strength and really confidence in their predictable recurring revenue model.
Well, I'm sorry, but I just don't quite buy that it's purely confidence driving this. When I look at the balance sheet, and especially the expense lines, I see maneuvers that look like they're born more out of necessity. So I contend these are actually vital defensive strategies, primarily designed, I think, to sustain key financial metrics, particularly that diluted net income per share, especially when faced with rapidly escalating input costs. These are, the structural expenses of moving their entire platform to an AI-driven model, plus the fierce competition they're now up against.
Okay, well, my conviction here, it really starts and ends with the consistency of their revenue engine. Adobe reported that subscription revenue now accounts for a staggering 97% of total revenue in Q3 2025. And that stream, it saw a robust 12% year-over-year increase. I mean, that's pretty much the definition of a dependable foundation, isn't it? It gives management the latitude, the freedom to engage in this kind of strategic financial engineering. Furthermore, the operational cash strength is frankly exceptional. Net cash from operating activities increased substantially for the 9 months ended August 29th, 2025. Now, the prior year comparison did benefit from the absence of that $1 billion Figma termination fee paid previously, but the absolute volume of cash being generated here remains massive, and that provides the necessary fuel for their aggressive capital return program. This strength allows for capital optimization. Look at the numbers. The company spent $8.8 billion on common stock repurchases in that 9-month period. That sharply reduces the share count and directly supports the impressive diluted net income per share over $12 for the 9 months. They are generating huge amounts of cash and using it proactively to optimize shareholder returns. And finally, we see validation in their growth segments. The business professionals and consumers customer group, that drove 15% subscription revenue growth in the quarter. That's noticeably outpacing the 11% growth from the, traditionally dominant creative and marketing professional segment. So they are successfully expanding their market reach.
Okay, you paint a compelling picture there, I grant you. A company with a strong cash register. But we really have to view that cash deployment, particularly the increase in debt and just the sheer volume of stock repurchases, in the necessary context of their increasing operational burdens. I don't think this is just strategic. I think this is compensating for structural changes. We see total liabilities increase substantially over the 9-month period. That's driven largely by a jump in long-term debt, which now sits above $6.2 billion. This new debt, I believe, is serving a purpose beyond just mere efficiency. It's helping fund operational scaling precisely when they're facing these alarming structural increases in input costs. Let's just look at the expense side for a moment. The most concerning element, for me anyway, is the cost of subscription revenue. It saw a really sharp 23% year-over-year increase in the 3 months ended August 29th, 2025. And management was specific about the drivers. They mentioned AI inferencing costs and hosting services. Now, this isn't temporary inflation, right? This points to a fundamental margin pressure that seems inherent in scaling these new AI offerings. And to execute that nearly $9 billion in repurchases, well, they had to heavily deplete their cash and cash equivalents. That's a drain of over $2.6 billion in just 9 months. That level of cash usage, it really suggests that maintaining that high diluted EPS figure was prioritized over preserving liquidity, especially amidst high operational investment needs. And the rising costs are, frankly, everywhere. Overall operating expenses are accelerating, an 11% increase Q3 over Q3, with sales and marketing expenditures soaring by 15%. That sounds like a clear defensive cost of fighting for market share in this newly competitive AI landscape. Let's focus right in on the implication of that 23% jump in the cost of subscription revenue. You mentioned the strong gross profit, and that's true in absolute dollars, but the rate of cost increase is what's alarming here. When Adobe specifically calls out AI inferencing costs, well, they are signaling a structural change in their delivery model. Traditionally, software as a service, especially for digital media, enjoyed extremely high gross profit percentages, right? Around 97% historically. But inferencing, that's the cost of actually running the AI models to generate results for users, like in Firefly. That is a highly variable cost. It's directly tied to customer usage, and importantly, the complexity of the AI model itself. This is fundamentally different from a traditional, more predictable hosting cost. It implies that the marginal cost of delivering their services is climbing dramatically as the product scales, and that potentially undermines the historically high profitability of their core digital media segment. We already see some evidence of this structural drag. The overall gross profit percentage actually contracted slightly, from 90% to 89% year over year for the quarter. Now, okay, 1 percentage point might sound small, but when you're dealing with billions in revenue, it signals a potentially significant headwind if these AI costs continue to balloon like this.
I see why you emphasize that contraction, but I think you might be focusing a bit too much on the rate of increase rather than the resulting success. That absolute increase in cost of revenue, yes, jumping from $413 million to $510 million in the quarter. That's the necessary price of success, isn't it? It is the cost of rapidly deploying and, frankly, future-proofing the technology needed to maintain market superiority in this new AI era. We have to look at the results. Even with that expense increase, the resulting total gross profit still grew robustly. It went from $4.85 billion to over $5.3 billion in the same quarter. So they are successfully scaling their revenue faster than this new cost structure is eating into the actual margin dollars. Moreover, the investment strategy seems quite measured. You're concerned about inferencing costs, which are operational, right? But the training costs for these AI models, which generally get categorized under research and development expenses, they show much more controlled growth. R&D was up only 6% quarter over quarter. This demonstrates, I think, that management is effectively distinguishing between the necessary, successful operational scaling costs driven by product adoption, that's the inferencing, and the measured, controlled upfront investment in R&D and training the next generation of models. So that small margin contraction, I see it as a tactical necessity, not really a sign of fundamental financial distress. Now let's address the motivation behind the capital structure decisions. The huge debt issuance and that nearly $9 billion in buybacks. I argue this is pure efficiency. The company utilized $6.25 billion through accelerated share repurchases, ASRs. Now, for listeners maybe unfamiliar, an ASR is essentially just a faster, more structured way to execute a buyback. It lets the company retire shares almost immediately rather than waiting for weeks or months of open market purchases. It's a mechanism built for speed and capital efficiency, maximizing the immediate impact on earnings metrics like EPS. And this was funded in part by strategically issuing new debt, $2 billion in new senior notes back in January 2025. This wasn't desperate borrowing, it was market timing. They capitalized on what were favorable market rates at the time, allowing them to actually retire some older, potentially more expensive debt, while funding these repurchases very efficiently. With $8.8 billion still remaining under their substantial $25 billion repurchase authority, this debt is simply a tactical move. It's deploying capital to generate immediate accretive returns, reinforcing this idea of strategic confidence.
Okay, I see why you focus on the mechanism. the ASR itself. But I view the entire structure as less about pure efficiency and more about, well, obligation. It looks like a massive outlay designed specifically for dilution management, not just optional capital return. Let's be clear about why Adobe might need to spend $8.8 billion on repurchases. We have to contrast that spending against the shared dilution that happens naturally through compensation. Total stock-based compensation, which involves issuing new shares to employees, totaled, $1.453 billion for the 9 months. That issuance increases the share count unless you actively offset it. And the company explicitly states that the massive buybacks are designed, quote, to return value to our stockholders and minimize dilution from stock issuances.
So they are spending billions of dollars, draining that cash balance down to under $5 billion. Primarily, it seems, to run just to stay in place regarding their share count. They are effectively using expensive debt and draining liquidity just to neutralize the dilutive effects of their own compensation structure. That ensures the critical EPS metrics remain high, which, to me, screams defensive necessity rather than purely returning genuinely excess capital.
Right, you are correct. The dilution management is a key factor mentioned. But I would argue that's a feature, maybe not a bug, of modern tech compensation structures. A company with the scale and, importantly, the cash flow of Adobe has the option to fund both its operations and its capital returns simultaneously. You point to the increased debt balance, and yes, it has climbed. But debt is often cheap compared to equity, right? So why hold billions in cash, potentially earning a moderate return, when you can issue debt at favorable rates, which they seem to have done, and deploy that cash back to shareholders via buybacks that immediately boost EPS? This looks like maximizing the cost of capital, potentially in a favorable rate environment, to accelerate shareholder return. The debt increase seems like an opportunity taken, not necessarily a liability incurred out of sheer desperation.
Well, if it's an opportunity taken, then why are they simultaneously increasing their exposure to volatile interest rates? We have to look at the financial risks embedded in their debt management strategy. The company entered into these, complex interest rate swaps related to $2.7 billion of their senior notes. Now, for the audience, this effectively converts the fixed interest rates, the predictable costs on those notes, to floating rates based on SOFR OIS. SOFR, the secured overnight financing rate, plus some applicable spread. Well, it means the interest payments on that $2.7 billion are now subject to the swings of the market. This decision seems kind of contrary to a strategy focused on long-term predictability, doesn't it? Especially when we consider that interest expense has already increased by 66% year over year for the 9 months ended August 29, 2025. That's largely due, they say, to higher average debt balances. So why would you voluntarily incur more interest rate risk if you are truly confident and stable? It suggests management might be optimizing for some external market factor, perhaps betting on future rate drops, rather than just securing operational certainty.
That's a compelling argument. I understand the concern. But have you considered that financial hedging decisions like these are fundamentally tactical? They aren't just a measure of risk aversion or lack thereof. A major corporation like Adobe, they don't enter into fair value hedges blindly. The decision to use swaps to convert fixed rates to floating rates is almost certainly a strategic, risk-managed call. It's made based on the market conditions and the company's own long-term financial projections at the time they executed it. The goal isn't necessarily just to avoid risk altogether, but maybe to manage the overall cost of capital. By converting $2.7 billion of debt to a floating rate, maybe they maintain flexibility, maybe improve liquidity somehow. They have clearly weighed the strategic benefit, perhaps lower current borrowing costs, or maybe the ability to efficiently fund those ASRs we discussed, against the risk of rate volatility. And they explicitly assess this risk in their disclosures. They state that a hypothetical 50 basis point change in market interest rates would not have a significant impact on results of operations. Now, that confirms to me that the strategic financial benefits of this, yes, highly managed debt structure, are seen by them to outweigh the relatively small short-term volatility inherent in their interest rate exposure. It looks like sophisticated balance sheet management, not necessarily reckless risk-taking.
But we can't just dismiss a 66% jump in interest costs as insignificant volatility, can we? It's direct evidence that the overall cost of servicing this increasing debt load is escalating rapidly.
And while the swaps might be risk managed in theory, they certainly add layers of complexity and likely cost that perhaps a purely confident, cash-rich company might choose to avoid in favor of simple, fixed predictability. They are funding shareholder returns and offsetting compensation dilution with leverage that is measurably increasing their cost structure, which again emphasizes the priority placed on maintaining that EPS figure over, say, maintaining a large cash cushion or minimizing structural debt servicing expenses.
Okay, so to summarize my position, Adobe's financial results, I believe, demonstrate robust, segment-accelerated top-line performance. It's driven by that predictable subscription revenue, the aggressive capital allocation strategy, including those massive stock repurchases funded partly by optimized, strategically timed debt, is a proactive measure. This isn't just about preserving metrics. It's about maximizing capital efficiency and preparing the balance sheet for the continued necessary heavy investment in critical high-growth areas like generative AI and platform expansion. I see this as strategic confidence built on what is still a deeply stable financial foundation.
And conversely, I maintain that while Adobe's ability to generate revenue remains undeniably strong, the rapidly escalating cost associated specifically with AI technology adoption and the necessary scale of sales and marketing, they place a critical premium on sustaining key financial ratios, especially EPS. The capital allocation choices, particularly that reliance on debt and the corresponding huge stock buybacks, will then appear necessary to neutralize existing dilution and uphold those EPS targets. This aggressive deployment of capital therefore points less to optional efficiency and more towards a required financial defense against the structural margin pressure and heavy investment inherent in their ongoing AI pivot.
Right. The financial reports clearly illustrate both the operational success and the intricate financial engineering tactics being used to support it. The material definitely provides the framework, but it does leave the sophisticated analyst and our listeners to weigh the evidence and determine whether the end goal, sustained long-term shareholder value creation, justifies this pretty aggressive shift we're seeing in capital structure and risk exposure. There is clearly much more to explore here, particularly in how these new AI cost centers will evolve over the coming quarters.